David Guttery is the Chief Executive Officer of InSOURCE Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, Chief Executive Officer of InSOURCE Financial Advisors, to talk about the Magnificent 10. Is it a boom or a bursting bubble? David, thanks so much for being with us today. You've actually touched on this within previous videos, but today I believe you're going to provide our viewers with a much more detailed discussion about a group of stocks that have come to be known as the Magnificent 10. How valuations reached these levels, and what might happen next, correct?
Indeed I am. Before we get started, I'd like to state that what I'm sharing within this video should not be construed as investment advice. I'm offering my thoughts and opinions on a topic that have been part of nearly every conversation that I've had with clients now for a few years. Anyone watching this video, however, should consult with their financial professional first before making investment allocation changes to their portfolios. In my opinion, yes, I believe these Magnificent 10 stocks, as they have come to be known, are overly valued, and there are a myriad of ways to quantify that on a spreadsheet. Yes, I do believe these AI thematic stocks have formed a bubble, but you know, not all bubbles are made from the same material. Some bubbles are made of soap suds and they pop almost as quickly as they form. Sometimes a bubble can be made from mylar. This one seems to be pretty resilient, but just recently, I believe, we saw evidence of just how fragile this bubble might actually be at the end of January. More on that in a moment. I think the key to understanding the magnitude of this event is to understand how it formed in the first place. Between 2021 and 2022, inflation began to increase significantly, and it reached levels that had not been seen in over 40 years. That had a chilling impact on patterns of consumption. You quit buying as many of these as you once did. We can see that clearly by looking at the ISM Manufacturing Index from its high in April of 2021 through its low in early 2023. Any reading above 50 is indicative of expansion. Here we can clearly see that the index dropped from a reading of 64.9 to 44 in almost 2 years. Manufacturers didn't just decide to stop making things, they responded to your patterns of consumption. Manufacturers broadly employed technology in an effort to make fewer things with the same profit margin, with fewer workers, and as remotely as possible. This was an inflation crisis-driven rapid adoption of technology. The problem is that this graphic suggests that the crisis that drove the bubble in the first place may be over. The ISM Manufacturing Index is once again above 50, indicating that expansion is underway. This is being driven by your patterns of consumption. Now the emphasis is seemingly on being bigger, not leaner. We see this in other metrics as well, like capacity utilization, durable goods orders, factory orders, and new orders. So the million-dollar question remains, how much longer will this bubble remain if the crisis that drove it in the first place is seemingly over?
Well, David, that's a great point. Well, within our last video, you suggested that we've seen this cycle before. Can you describe what you believe to be the similarities between now and the Y2K crisis of 25 years ago?
Absolutely. For me, this is the 20,000-pound gorilla in the room. For those of us who remember Y2K, in my opinion, you can see very stark parallels between these two periods of time. The one key difference is that I could circle January the 1st of the year 2000 on a calendar. At 12:01 a.m. on that day, that crisis was over. We don't have that luxury today. Can certainly narrowly defined sleeves of stocks melt up without a rational spreadsheet justification? Yes, absolutely. It happened 25 years ago. Back then, Cisco, among other technology stocks, did that very thing. In the lead up to Y2K, the Federal Reserve, once again, made an enormous amount of money extremely available and very cheap. Companies largely borrowed and bought their way through that crisis. As a result, we saw the basket of technology skyrocket to untenably high levels. After January the 1st, all of the machines worked. The crisis was over. Orders dried up and the values of the stocks plummeted. These companies did not become 80% less valuable overnight. In my opinion, this was a collapsing cascade of algorithms. Understand that high-frequency trading that we had 25 years ago was driven by a horribly outdated technology by today's standards. Today, through high-frequency trading, algorithmic-driven trading, billions of dollars worth of securities can be exchanged in a matter of seconds. I don't know if we will see a similar phenomenon this year, but it will not surprise me if there is a retracing of gain from among these stocks. From time to time, when I draw a correlation between Cisco in 2000 and NVIDIA in 2025, it's not uncommon to be met with, "It's different this time." Actually not. There is nearly a perfect correlation between the patterns of behavior that we observed 25 years ago with Cisco and today with NVIDIA. Now, I can't guarantee that NVIDIA won't rocket through the top of the spreadsheet, but you can't ignore what seems to me anyway to be mounting evidence that maybe a correction in valuation may be closer at hand than not.
Well, that's very interesting. And yes, I clearly see the correlation that you're describing. So David, you've talked in the past about how these valuations are skewing market indexes. Why is this important and something of which our viewers should be aware?
Great question. At the end of last year, we observed that 10 stocks comprised 40% of the weight of the S&P 500 index. There are 503 stocks in the S&P 500 index. 10 of them carried 40% of the weight. We have never seen anything remotely close to this in the history of the index, and frankly, it dwarfs what we observed 25 years ago during Y2K. The last time we observed a rapid adoption of technology when driven by a crisis. Let that sink in. In my opinion, there is much Pollyanna in the media right now about how this might impact the market. Again, there are 503 stocks in the S&P 500 index after all, correct? Yeah, but remember they are weighted by capitalization. This is not an evenly weighted index. Looking at a graphic such as this tells me that indeed the fortunes of the index could largely be driven by only a handful of stocks. I am seeing bombastic headlines such as this and articles that go into detail about how the stock market might experience a long and sharp and deep pullback this year. Well, I suppose that's possible at any time, and at a high level I agree. In my opinion, the headline index itself might appear to be struggling should 10 out of 503 stocks retrace gain in a significant manner. However, it is also my opinion that much of the remaining market is undervalued. And as gains are harvested, those proceeds may find new homes in other undervalued areas of the market. It could be that while the index appears to be losing ground, investors notice that their accounts are appreciating in value. So once again, we cannot be caught up with the sensationalized headlines. You must look more deeply than just the surface to appreciate the odd period of time within which we find ourselves and understand how we got here. Those who forget history are doomed to repeat it. All we have to do is look back in time at other parabolic moves to see how events in the past have led to factions of equities becoming overly valued. You'll notice the Magnificent Seven in red on this graphic, and it would appear that we are nearing the inflection point where we have seen many other parabolic moves roll over and retrace gain. Again, clearly, I can't predict when that will happen, but I believe it remains in front of us. So investors, in my opinion, should be aware of the premiums that they are paying as this AI thematic parabolic moves continues to age. At a time when economic data suggests that manufacturing capacity should increase to meet the increasingly greater demands for goods and services, supported by increasingly lower inflation and capacity to consume widening, I have to ask, when does the market recognize that a shift away from being leaner to being bigger may be unfolding? Should that realization occur, then how does that translate into what seems to be an overly valued narrow sleeve of stocks that were driven to these levels by an inflation crisis that seems to be resolving? Again, I can't give you a date on a calendar, but it hasn't happened yet, so it remains in front of us.
Well, David, you mentioned at the beginning of this interview that something happened at the end of January that gave you pause regarding the valuation of the Magnificent 10 stocks. Might that date on the calendar be closer than we think?
It might be. So in the early morning hours of Monday, the 27th of January, a rumor launched from China while we slept. As we awoke and consumed our news that morning, we heard about some new technology called DeepSeek, an open source AI model that was purported to be more efficient and more cost effective than ChatGPT. Well, I suppose we'll find out in time if that claim is true or not, but that's really not the point. The point is that it only took a rumor for the AI thematic segment of the market to capitulate violently. NVIDIA set the record on that day for the largest one-day loss in the history of the U.S. stock market. Indeed, that wasn't the first time that NVIDIA had claimed that title. NVIDIA actually owns 8 of the top 10 worst one-day losses in the history of the stock market. So this shows you how nervous this overly valued market segment might actually be, and with only a rumor, valuations can change very quickly. I don't know if this will be a persistent theme throughout the year, but then again, that's not really the point. I'll never tell you anything that I can't put on a spreadsheet. When I say that this sleeve of 10 stocks is overly valued, I think this chart demonstrates what I mean pretty well. Pick your geometric mean regression. We have never seen a basket of stocks trade at more than 3 standard deviations away from a historical mean that dates back to 1900. Again, for context, you can clearly discern the Y2K period of time. From the perspective of valuation, there's a lot of industry chatter about how the market is overly valued in terms of trailing and forward earnings multiples. Well, again, you have to keep in mind that 40% of the market they described is comprised of only 10 stocks. And again, in my opinion, they seem to be overly valued. In this chart, if you look at the cap-weighted market itself, it seems to be trading at 24.7 times earnings. However, if you looked at the market from an evenly weighted perspective, where NVIDIA carries the same weight as Kellanova, for example, you get a far different picture. An equally weighted market is seemingly trading at 18.3 times earnings. That's a 26% difference. Now, I don't have a chart to demonstrate this metric, but when I carve these 10 stocks out of the index, by my calculations, it appears to be trading at around 14.8 times earnings, and that, historically, is very healthy. In other words, in my opinion, the vast majority of what we call the market isn't overly valued as a function of earnings multiples. These 10 stocks are heavily skewing that metric.
David, let me approach this from a different angle. Instead of being mindful of potentially overvalued investment opportunities, in your opinion, how might investors consider incorporating this technology movement into their long-term portfolios?
Another great question. So again, let me offer this disclaimer by saying this is not to be construed as investment advice to anyone watching this video. As always, investing strategies should be carefully considered across many factors that are unique to you, including tolerance for risk. I am intrigued by the rapid emergence of data centers across the world and in the United States in particular. Well, okay, it occurs to me that these data centers must be kept at a constant temperature, so HVAC solutions are important. They must have rigid security protocols in place. Building automation is a central element as well. You can't brown out a data center, so having a source of uninterruptible power is critical. Power distribution, server cabinets. Power distribution are all critical elements of data center construction. They also eat power. In October, it was announced that Constellation Energy would restart Unit 1 at 3 Mile Island and sell that power to Microsoft. We neither have the capacity nor the grid to generate the amount of power that these data centers will require. So in the future, as data centers emerge, I believe that power generators will be seen as growth stocks and not the value stocks as we have historically known them. The point is, there are always ways to incorporate this AI thematic trend into portfolios without direct ownership in stocks of companies that may have melted up to frothy levels. You just have to think outside of the box and do your research. So in closing, again, let me remind everyone that while a topical discussion like this is useful, it should just be another facet of a product-agnostic approach to holistic financial planning. Where a portfolio is allocated at any given time should entirely be a function of long-term planning goals that you're trying to accomplish, and it should reflect your investor DNA in terms of risk tolerance, for example. Don't just jump into a market area because you think there's a quick dollar to be made. Every decision should be made in the context of, how does this fit into my long-term planning goals?
David, thank you so much for this information, and for additional information, David may be reached through the means listed upon the following screen. For InSOURCE Financial Advisors, I'm Brannon Dawkins.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.